Hello and welcome to Fidelity Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lukasz and I'm pleased to host today Min Zeng, our portfolio manager for the Fidelity Japan Equities Fund. Welcome, Min.
Hi, thank you very much for having me.
So you're here for a few days in Australia, and always I like to get a feel for how people, a bit of their background, how they've got into this industry. And you did have a little anecdote on how you first got into investments and your first investment. Tell me about that.
Sure. I studied finance in undergraduate school at McGill in Canada. Mm-hmm. With that, my first part-time job actually was at a buy side in Montreal.
Yeah.
It's called Jarislowsky Fraser.
Mm-hmm.
I was a junior analyst, mm-hmm. Making financial models for Japanese companies for the more senior analysts. That was my kind of first-hand experience. I thought it was very interesting, just simply modeling the future of mm-hmm. companies. Back then, I remember one of the analysts we were discussing, and she said, her name was Kimberly, if you are going to be an equity analyst, the best company to be in this industry is Fidelity. Mm-hmm. That was my first time I actually knew mm-hmm. about this company. Mm. And the rest is kind of history.
There you go.
In terms of my first investment experience itself, I graduated in 2010, 11, that kind of era. So mm-hmm. I went through the financial crisis while I was in mm-hmm. University. At that time, I remember, all the big American companies like General Motors, mm-hmm. Ford at the brink of bankruptcy. Mm. So my first investment actually was, I was supposed to use the money, $900. I think it was for 2 textbooks for that semester. I told my parents somehow I didn't have enough, but I used that money to invest in GM when it was maybe I think $1 or $1.80 or something mm-hmm. like that. I just thought there was absolutely no way such a company like General Motors mm-hmm. of United States of America mm-hmm. can stay at this value for long. I did have the choice to choose between General Motors and Ford. I didn't really know how to choose. I just thought, okay, let me just eeny, meeny, miny, mo. Mm-hmm. I ended up choosing.
Great process.
Yes. It was my first process. My investment, $900 in GM, went to zero. Ford, I think, was a multi-bagger mm-hmm. after that as it recovered. So my first lesson was, if you're going to do that kind of investment analysis of the financials mm-hmm. of the balance sheet of how long a company can survive through those type of periods, mm-hmm. that's going to make or break your investment. So that was my first experience.
That's a brilliant lesson. And how'd you go with a semester with no textbooks?
I did. My parents were relatively forgiving if it was money for education. I made up a good excuse to have more
Very
funding.
Good. Very good. It's always, there's nothing like having skin in the game to teaching you about markets. So that's a great sort of reflection. So maybe if we sort of start off and head down the path of Japan. So Japan's mm-hmm. been a really interesting market over many years. I guess, for people that are listening that have, maybe followed Japan to some degree, probably some of the key things that come to mind is mm-hmm. deflation, it's slow sort of growth, it's one of, maybe companies not acting in the best interest of shareholders. Mm. And maybe that's a bit of a sort of historical mindset. But I guess it feels like there's been a real shift in Japan for some time now mm-hmm. in terms of some of those structural things. So interested in you just running through maybe where we have been, but what are some of the really exciting changes that we're seeing now in the market that have taken hold?
Sure. I think to put it simply, the biggest change that's happened in Japan is inflation returning mm-hmm. and the belief by corporates and consumers alike that this time it's probably here to stay. It's structural, not a one-off. Mm-hmm. That changes the way many companies think, consumers think, and how people and corporations take action. Mm-hmm. I think, this corporate governance push that maybe more recently has gotten attention in Japan, given how the markets have moved. It's not something that just started, mm-hmm. this year, last year. It was actually almost a decade ago mm-hmm. when our back then, Prime Minister Abe mm-hmm. came in and really drove the initial drive to introduce corporate governance codes, stewardship codes, improve corporate management structures, the board mm-hmm. structures. That mm-hmm. process has been a decade-long process. Mm-hmm. Mm-hmm. One thing that Japanese corporates are accused of being poor at is capital allocation, and more specifically, too much cash holdings on the balance sheet. Despite the past decade of corporate governance improvement push, I think, if you think Japan, if you're under deflation, what that means is if I have cash and I invest it into a factory or some specific asset, the chances are that asset will deflate because the products that I'm selling, the prices are declining, volume may or may not be growing. Why would I spend that cash to invest in capacity in CapEx or R&D? So deflation was a very big reason. Even if company wanted to be good, it's natural to accumulate cash.
Yeah.
So I think this time around, what's really changed is the combination of pushing companies to think better, but also the fact that inflation coming back gives companies a different outlook of the financial models. Prices, I can now raise my prices. That makes a big difference in my revenue forecast. That means I have new areas I can invest in that that makes more sense than before. I am well aware now that by storing cash on the balance sheet under inflation, my cash is the value of it is depleting. So I am urged by shareholders much more than before to either spend that on growth, CapEx, or return it to shareholders if I'm not using it appropriately. There's a much more natural push to deploy capital better. So those are the two. Well, not the number one change, I think, is inflation.
And you mentioned the consumer as well. And I guess, have you sort of observed a shift in consumer behavior as a result of inflation picking up? Because again, to your point, if you're in a deflationary environment, you probably hold off on a big purchase maybe because actually that product item might become cheaper over time. So have you seen a tangible change in behavior from consumers?
I think so far, because we are still in that first phase so for a positive inflation cycle to work, you need, of course, not just prices of things going up, but wages also rising and hopefully rising faster than the rate of inflation for people to actually believe I can spend more tomorrow. What's happened in Japan up until now is in the past few years, in the past 2 years especially, there has been a much higher level of nominal wage growth, very much pushed by the government, urging unions through their annual spring labor wage negotiation process to really push for, well, these days we're saying 5% nominal wage growth. That 5% includes a 3% actual base salary increase, and about a 2% kind of natural, as people get older, there's this general slide upwards in terms of their career. And so the real number is actually 3%, even if they push for 5%. The problem so far is that the rate of inflation in Japan, with the currency weakening very substantially, the inflation has been a little bit higher than this 3%. That eventually, it's coming down now towards, I think, mid-2s. If inflation can settle finally at 2%, which is the government target, and wage growth can stay at 3%, then you finally get real wage growth. Real wage growth. And then the consumers can finally react. So to your question, what's happening so far today is there's the first parts of that wheel beginning to turn. However, the consumption is only strong so far in the wealthiest cohorts. But the rest of the market, we're still seeing consumers trading down or reducing volume of consumption as prices are being raised so far.
Yeah, I think when we were speaking, you mentioned there was a company, I forget the retailer clothing brand that Japanese that you invested in, that you've noticed this sort of real ramp up in the consumer trading down.
Yes, so the Japan Equities Fund does invest in a clothing retailer called Shimamura. This is a really kind of boring business traditionally. It's domiciled in Japan. There's not a lot of international growth potential. It does have clothing at a lower pricing point, and consumers, as I mentioned, are trading down. So the basic growth of the business is actually positive now, even though it's not that exciting. This is a company that's priced at 13 times price to earnings, which is kind of relatively cheaper for a retail business in Japan. But half of its market cap is in cash, net cash that it has accumulated over the years. So it's very, very cheap, and it can take action on that if it wants to. And we are in the process of engaging with management to discuss what kind of actions they can take to really achieve a much more ideal balance for their balance sheet.
Yeah. And I think the interesting one, I mean, one of the interesting developments that we've observed in the Japanese market is also the Tokyo Stock Exchange. I don't know what you want to call the list, the name and shame list, I guess. But it's about sort of companies that are sort of trading at below the 1% price to book level, which is a valuation sort of indicator. Just elaborate on that, because it's an interesting development, but it's also an interesting sort of the psychology of, you don't want to maybe be in that camp, I guess. Can you talk through that?
Sure. So this was a directive that somewhat surprisingly came out in March of 2023, where the stock market told basically companies trading below book value to really publish their view on what is your cost of capital, what is the return on your business, why is your return low, and what are you going to do to rectify that situation and disclose that to investors in public. And the stock exchange, beginning of January this year, started to disclose a list of companies that actually began to disclose their plans and companies that haven't. It's quite a mechanical way to force companies to take action, and it's almost a little bit of a high school, type of. But Japanese management or people are good at following rules, and there's also a tendency to look at what your peers are doing and follow. So when you are told to do something, companies actually diligently do what they are told, especially if your competitors are also taking action. So far, we've seen a very strong ramp up in companies that have been making these type of disclosures. From here, it really is about choosing the companies that can execute on their analysis and execute on their plan to rectify that situation. A lot of that comes from our ESG team as we engage and discuss with management after they publish these thoughts, how quickly, how much they are committed to actually achieving those goals, and those can arrive at investment ideas for the fund.
So I mean, I think generally it's pretty fair to say it feels like there's a real sort of elevation in terms of governance across the board, as a result of these sort of, not an overnight thing, but a number of years that's occurred. Just if we talk about sort of the Japanese market, we have seen certainly over the last couple of years the Japanese market returns be pretty good, pretty strong. There could be, an argument, well, we've seen this rally. Is that it? Maybe Japanese equities are overpriced. All of those sort of, things can go through people's minds. What are we actually seeing though? What are you seeing on the ground in terms of where valuations are at and also where, the potential growth opportunities are?
I think if you take a kind of step back and look at the market as a whole, as if it was like a stock, a single stock, usually stocks are driven by one, the earnings trajectory. In the long term, it follows earnings, and then there's a multiple that the market ascribes to that. Japan in total, if we look at this past decade, the earnings per share growth of Japan Inc., that growth rate has been comparable, actually one of the highest growth rates in local currency terms versus all of the developed markets and the emerging markets. So the EPS growth of Japan Inc. has already been one of the highest. The market today, after the rise over the past few years, the multiple now is close to mid-cycle. So something like 14 times forward PE, which is no longer very, very cheap if you compare it to somewhere like China. But it's still inexpensive when you compare it to markets like the United States. Of course, there are industrial structural differences, sector weighting differences that really are good reasons for the market to be priced differently. But the message is earnings growth have been one of the highest in global markets. PE is mid-cycle. From here, then, the story is, can we believe that earnings per share growth of Japan can continue its past trajectory and even be better now that we are in inflation? Companies have more ability to raise prices and a sharper focus to improve their margins, driving EPS. And through improving margins, through better balance sheet management, raising the ROE of their overall businesses, can the market eventually deserve a re-rating further beyond its historical kind of mean level? So those are the two big, I think, longer term drivers.
Absolutely.
That are probably the strongest drivers for the market from here.
Yeah. So to your point, it feels like we're sort of mid-size, a fair bit of runway to go.
Yes.
From the market. So if we look at some of the opportunities and maybe a couple of interesting stocks that you're looking at the moment, and one that comes to mind is Sumitomo Forestry that I know we've spoken about in the past. It may be actually familiar to some Australians as well in terms of housing and construction development. But tell us about that company and why you find it such an interesting investment opportunity.
Sure. So Sumitomo Forestry, even though there's forestry in the name, the main business really doesn't have anything to do with forests. It does own some forests, but it's primarily a home builder. And 70% of its earnings comes from U.S. single-family home supply or construction. So this is a Japan-listed stock, a Japanese builder, but actually it's primarily a U.S. new home builder. It's comparable to something like Lennar or NVR, D.R. Horton in the United States. In the past decade, this company has been very diligently deploying its cash flow generated from Japan and buying more and more U.S. home builders. Today, its market share makes it a top 10 new home builder in the United States.
Okay, wow.
So it's a big player. This is a stock that is 7-8 times PE. When the fund bought it, it was cheaper, a little bit more cheaper. Today, it's about 8 times PE, 1.4 times book, not too far above book. It yields 4+ % dividend yield versus the Japan market at 2.5%. It's a value stock, but the business fundamentals, being a U.S. new builder, the fundamentals should accelerate and improve when the U.S. rates eventually come down, which is usually a growthier environment for a value stock. So it's a business with strong competitive advantage, being one of the top builders, being in a very attractive market in the United States with very strong long-term fundamentals given the undersupply of U.S. housing versus population growth. And the fundamentals should accelerate from here while still being 8 times PE.
Yeah.
So that's probably, of course, the weighting in the fund will change over time as the stock moves and the upside and downside changes, but it's likely to be a core medium-term holding.
Yeah. So maybe if we sort of, final question from me, if you sort of think of the year ahead, 2025, obviously there's been this year's been a lot of moving parts. We've had big elections around the globe. We've had inflation starting to moderate, which is positive. What are the key things you're thinking about for 2025?
Okay, so I think from top-down macro, one obviously important market for Japanese companies is the health of the U.S. economy. I think we are still in that debate of whether U.S. achieves quote-unquote softer landing or not. To gauge that, the labor market data that's coming out of the United States will be quite critical because employment determines the consumer's willingness and ability to spend eventually. So that's a number, especially unemployment is a number that has been rising. Whether the rise in unemployment can stabilize into 2025 or whether it continues a sharper rise, that's a key critical factor to watch out for the United States. One more interesting outside market for Japan that's important is China. And the policy push or support that the government is putting in place for some of its battled industries like real estate, the support for consumers, whether they can actually have an impact on the consumers and on some of the industrial sectors of China, where the impacts can actually be sustained and by how much, that's something that will greatly impact some businesses in Japan for us to watch out for. So I think if we look at the kind of broader kind of global context, there are some important conflicts that have been occurring across the world that have impacted input costs, energy costs, supply chains. What happens there, how quickly some of those resolves, those will also have impacts on Japanese businesses. So that's kind of the broader things to look out for. From a bottom-up Japan perspective, I think, one, we are still very much at the cusp of real positive wage growth. We're still at the early phases of confirming month by month that shift. If that is sustained, how that really begins to change consumers going into 2025, that's one area to watch out for. On the corporate action side, we are already seeing an increase in shareholder returns through rising dividends or larger buybacks, more buybacks announced by more companies. But the next phase to watch out for is corporate restructuring. That's something that's obviously not done easily or quickly, but that is quite key for the Japan or in the Japanese market to structurally improve its earnings power and ROE to justify a re-rating of Japan as an entire market. So finding companies that can execute on some of those business restructurings, that's something to continue to look for in 2025.
Brilliant. Well, Min, thank you very much for your time and enjoy the rest of your time in Australia and look forward to speaking to you again.
Thank you very much for having me, Lukasz, and thank you for your time, everyone.
Thank you for joining us in this month's podcast. If you'd like to subscribe, please reference your favoured podcast platform, or if you'd like to provide us feedback, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.